Chip designer ARM Holdings reported earnings last week and the stock soared over 60%, taking the market cap to $121 billion. Shares are now up almost 150% since October. Based in the UK, ARM makes money from license fees and royalties for its CPU processors. The recent boom in artificial intelligence is causing strong demand for ARM's designs, with total revenue in the latest quarter rising 14% to $824 million. The company has now reported $2.9 billion of revenue over the last 12 months, $240 million of ebitda and $720 million of free cash flow. Stock-based compensation, however, is high at $900 million and net income is low at only $85 million. So ARM looks incredibly expensive at 41 times revenue and 165 times free cash flow. Even adjusted earnings, which are estimated at $1.22 for the full year, leads to a sky-high PE of 94. That valuation only makes sense if ARM can back it up with spectacular growth, and there's no doubt that the business can grow significantly in the future. Its chips are used in nearly every smartphone, and ARM should continue to benefit from the boom in AI. ARM's Cortex-XR, for example, is enabling generative AI and large language models on the latest mobile devices. The company should also grow market share in cloud computing and self-driving, but while the company has good prospects in those new markets, most of its current revenue is from smartphones, a maturing market. In fact, the number of ARM chips shipped last quarter actually fell 3%. And although top-line growth is good, it pales in comparison to some other AI stocks. Full-year guidance suggests 19% growth, so investors are clearly paying up for future revenues that are not yet forthcoming. And it's worth noting that a quarter of ARM's revenue comes from China, which exposes it to geopolitical risk. There are technical considerations too. 90% of ARM is owned by Japanese firm SoftBank, which means the number of shares on the public market is less than 10% of shares outstanding. Such a small float can lead to outsized moves in either direction. Also, ARM's IPO lockup period, which restricts insiders from selling the stock, is due to end in early March. Once that lockup period ends, insiders are likely to sell some stock, and that can cause pressure on prices. Together with the eye-popping valuation, I think there's enough reasons to stay away from this stock, but these are my personal opinions, not financial advice, and I hold no position in ARM. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.